Let's get a check now on the state of consumer demand with Levi Strauss, company delivering a beat across the board in the first quarter, but shares did plunge 16% on the day of earnings last month after outlining a cautious macro outlook and margin pressure triggered by higher levels of promotion. Here with me in a first on CNBC interview is Levi's CEO, Chip Bergh. Nice to see you again, Chip.
Good to see you
The only
again.
man at Milk and wearing jeans.
That's right. It's in my contract.
You got to change business casual. So what is happening out there? Investors were disappointed with the outlook you gave and the impact of the macro outlook.
Yeah, we said coming into the year that this was going to be a challenging year, navigating, the macro environment with inflation being very, very high and the fear of recession still being out there. There's no question that, especially here in the U.S., we're seeing a bifurcation of the consumer. The lower-end consumer is definitely stressed right now. We have two value brands that compete mostly in the mass channel. Those brands were down double-digit this past quarter. But where we're in control of the Levi's brand and where we're in control of the business, the Levi's brand is really, really strong. The brand was up 9% in constant currency last quarter. Our direct-to-consumer business, our own retail stores, our e-commerce business grew 16% this past
wholesale
quarter.
is under pressure.
It's U.S. wholesale is
department stores.
There were three issues that really triggered the reaction on Wall Street. One was U.S. wholesale being very, very soft, not just for us. It's really endemic to the macro system right now. Number two was our gross margins being under pressure because of high levels of inventory, which was the third issue, and a very, very promotional environment. We made some conscious choices to begin clearing some of the inventory. Our inventories finished the quarter up 33% versus a very depressed year ago. But we knew that this year was going to be very, very challenging. A tale of two halves is the way we're talking about it.
The first half rough?
Being very, very soft because we're up against a huge base period a year ago when the business was really strong, growing double digits. And the second half, we're up against a very weak base period, and we're expecting a much stronger second half.
I'm curious about that second half outlook, though, because while comps are better, forecasts for economy are getting worse.
Right, and that is the big reason why we maintain guidance. Despite beating consensus, we maintain guidance really as a matter of prudence and just out of some concern about the macro environment and being able to navigate it.
It really is confusing when it comes to the consumer, Chip, because LVMH becomes the most valuable company in Europe, past $500 billion, on a day where Bed Bath & Beyond files for bankruptcy. I know there's management issues to discuss there, but such a big gap.
Yeah.
So where are you on the luxury spectrum?
It's also all over the world, too. The environment in different parts of the world is very, very different. But as I said, the sweet spot for the Levi's is that $50,000, $150,000 consumer. That consumer is still buying. Our direct-to-consumer business was up, as I said, 16%. Internationally, the consumer seems to be much stronger. Yeah. And our business internationally was up double digits. So it really seems to be centered in the U.S., centered on that low to moderate consumer that is really feeling the stress of inflation and the fear of recession.